You know, every great business starts with an idea, right? But what makes it real isn't the product or the marketing. It's a decision, a really fundamental one. It's about its legal identity. So today, we're going to break down that very first super important choice every single entrepreneur has to make.
Okay, so you're fired up, you're ready to build something amazing. But hold on a second. First, you've got to answer this one big question. From a legal standpoint, are you and your business the exact same thing, or are you creating something totally separate, something that can stand on its own 2 feet? I mean, this single choice, it's going to define everything, your risk, your taxes, your whole future.
And this is why it's such a big deal. Look at this. On one side, you've got your personal assets, your house, your car, your savings, everything you own. And on the other side, business debts, a loan, a lawsuit, an unpaid bill. The core question for any founder is, just how thick is the wall between these two? Or is there even a wall at all?
All right, let's dive into option one. This is the sole proprietorship. I kind of think of it as the lone adventurer path. So, a sole proprietorship. This is pretty much the default setting for a new business, mostly because it's just so simple. Legally, there's no fancy paperwork to create a whole separate thing because, well, there isn't a separate thing. The business is you and you are the business. You can even run it using your own social security number. Though, pro tip, getting a separate employer identification number, or EIN, is a really smart move. It helps keep your personal info a bit more private.
So here's the deal, the big trade-off. On one hand, it's unbelievably easy to get started, and you are the one and only boss. You call all the shots. But, and this is a huge but, the major downside is that unlimited personal liability. What that means is there's literally no wall between your personal finances and your business finances. If the business gets into trouble, like gets sued or can't pay its bills, your house, your savings, it's all on the line. Oh, and another thing, you can't really sell the business as a whole entity. You can only sell off its parts, like the equipment or your list of clients.
But hey, what if you're not a lone adventurer? What if you've got a co-pilot? Well, that brings us right to our second stop, partnerships. This is all about sharing the journey.
Now, a partnership is more than just, say, two people splitting the rent on an office. The IRS is pretty clear on this. It's a joint operation where the whole point is to generate profit together. It has to be an active team effort, not just sharing some property. And right here, inside the world of partnerships, there's a really critical split you need to know about. You've got the general partnership where, you're right back to that unlimited personal liability problem. And what's worse, now you're also on the hook for your partner screw-ups. Yikes. But then you have the limited liability partnership, or LLP. This one actually builds that protective wall for all the partners. That's exactly why you see professionals like lawyers and accountants using it all the time. It helps them manage that shared risk.
Okay, all this talk about risk brings us to our third option, and it's a big one, the LLC. Think of this as your shield. It's really the modern, super flexible solution to a lot of these problems. The limited liability company, the LLC, it's a true game changer, a real hybrid. What it does is give you that strong liability protection you get from a corporation, that solid wall between your personal life and your business, but it combines it with incredible flexibility when it comes to taxes. You actually get to tell the IRS how you want to be taxed. You can say, hey, treat me like a sole proprietor or like a partnership or even like a corporation. You literally get to choose what works best for your situation.
And yeah, that amazing combo of protection and flexibility, that is precisely why LLCs have just exploded in popularity. They've become the #1 go-to choice for new businesses here in the US. For a ton of entrepreneurs, it really is the best of both worlds. But what if your ambitions are even bigger? What if you're looking for outside investors or planning for massive growth? In that case, a shield might not be enough. You might need to build a whole fortress. And that leads us to Section 4, corporations. And when we talk about these fortresses, we're really going to focus on the two main types you hear about all the time, the C corporation and the S corporation. They've got some things in common, but the way they handle taxes, well, that creates a world of difference between them. All right, first up is the C corporation. This is the classic, the OG corporate structure.
It's a completely separate legal entity from its owners. I mean, it's its own person in the eyes of the law. This gives you the absolute strongest liability protection you can get. But it comes with a pretty famous catch, and you've probably heard of it: double taxation. The profits get taxed once when the company earns them, and then they get taxed again when they're paid out to the owners. So let's break down how that double dip actually works. It's a two-step process. First, the corporation itself pays income tax on whatever profits it makes. Then, whatever's left over, when that money is distributed to you, the owner or shareholder, you have to pay personal income tax on it as a dividend. So yeah, that same dollar gets hit twice. That first tax hit at the corporate level is currently a flat 21%. And look, nobody loves paying taxes, but for bigger companies that want to reinvest a ton of their profits back into the business, this flat rate can actually be a pretty big advantage. The rate doesn't go up as the company earns more, which makes planning a lot more predictable. Okay, so you're probably thinking, how can I get that fortress-level protection of a corporation, but, skip the double taxation? Well, there is a way. It's by making a special choice with the IRS to become an S corporation. An S corp is what's called a pass-through entity. This just means the profits and losses flow or pass directly through to the owner's personal tax returns. It completely skips that first layer of corporate tax. But of course, there's always a catch, right? To get this awesome tax advantage, you have to follow some very, very strict rules. An S-corp can't have more than 100 shareholders. They all have to be U.S. citizens or residents. You can only have one class of stock, which simplifies things, and other corporations or partnerships can't be shareholders. So if you're dreaming of complex ownership structures or bringing in investors from other countries, an S-corp is pretty much a non-starter. All right, so we've been on quite a journey through these different structures. Now we're at the final section. How do you actually choose? Let's put this all together. This table really lays it all out, nice and clear. It shows you the fundamental trade-offs. As you go down the list, from a simple SO prop, things get more complex to set up for sure. But at the same time, your liability protection gets way, way stronger. The whole game is about finding the right balance for you, the right mix of simplicity, protection, and how you want to handle taxes, all based on your specific goals. And that's the bottom line, really. There's no single best answer here. The right choice for a solo freelancer is going to be totally different from a two-person law firm, and that's going to be different from a tech startup that wants to raise millions in venture capital. This choice is really a reflection of your own unique path, your vision, and how much risk you're comfortable with. So, just remember, this isn't just about checking a box on some government form. Your business structure is the foundation. It's the literal groundwork that your entire story will be built on. So, the question is, what will you build? Thanks for joining us.